Hello everyone, welcome to today's session. Let's get underway here. We'll start out with talking about market conditions currently and some of the sectors, some of the commodities as well. And we'll talk a little bit about market position as far as what that means, what to do when we have certain market conditions. So again, starting with directional alerts, that's typically the first process when you're coming to the site and you're beginning your analysis and you're starting out. First step is that big picture. What's happening in the long term? What's the long-term trend? We certainly know that the S&P 500 over the last 20 years, this has essentially been the major trends that the S&P 500 has. In essence, it's been one massive long trend, but there have been shorter term downtrends along the way. We really haven't seen, going back to 1998 and 9 and 2007, really anything like this before as far as a retracement. So we really haven't had a real big bear market. Back here we had two of them, and then we've just kind of been cruising ever since. This one was a decent one. So we're at this level now where we're right at the top of this 20-year trend and right at the top of all-time highs. And what does that mean? Well, one of the things we know is that when we're dealing with anything that has to do with market cycles, and we have to do with human behavior and greed and fear cycles, we always overshoot. Okay, we're going to overshoot being too greedy, and we're going to overshoot being too fearful. And that overall trend, that long-term trend, is typically pretty sustainable, about that 45-degree angle on most chart patterns when it's just kind of moving up about like that. And we have these big rallies up, and then we retrace those back down. We find equilibrium. We find a place where the market believes that that's a true valuation metric for where price should be. Markets are simply a live, real-time price discovery mechanism. They're always, the market is always anticipating what it thinks is going to happen, and it's going to make its bets based on what it believes is happening. Or once something is happening, then it's going to always look past that and look forward. So when we're, earnings examples are a good example of what happens with price discoveries, because there's information that's not known to most investors. It's called inside information. Obviously, when a company reports its earnings, it does it at a certain time, at a certain and using a certain process, because that's information that the market doesn't know yet or shouldn't know yet. And once it does, it's going to change the perspective. It's going to change the outlook of how we see pricing, okay, or how we see the growth of that company. Maybe they say, wow, we had a blowout quarter and we increased our revenue 100% year over year, but the market thought it was going to increase 20%, but it increased 100%. That's called a surprise, okay, a surprise earnings, and you get these massive gaps higher. You get a big run up because the market knew it was going to grow, but maybe not that much. So once that information is known, then price discovery happens instantaneously, okay? Buyers are thinking, wow, that was way better. We're buying more shares because that is going to, the value of the company has instantly increased because now their earnings are known. So that's happening every single day, every single minute, every single second, essentially. Some kind of information is being decided upon, and buying and selling is happening. And this is the real big, massive picture of that for the S&P 500. Okay, markets are, they're believers right now. No matter what the Fed is doing or what inflation is doing or what all of these things, or what Trump or what Biden or what the economy or what, Howard Stern or what, any information, the Ukraine situation, all of that, oil prices, it's always priced in real time into the market. So as the market believes that we are not in a recession, or we're going into a recession, or earnings are going to decrease or earnings are going to increase, markets are going to place their bet, or market participants are placing their bets. Okay? And right now those bets are still to the upside. That's the real big picture, but we also know that it's been that way. We're sitting right at the upper end of this range, and that's also not sustainable. Okay? But it can be sustainable for longer than we think. Okay, sometimes months or years, we can continue to see these uptrends take place. So that's ultimately what we are banking on as momentum traders, is we're looking for things that are going up in value for the most part, and then when they start to go down, we want to get out and exit and utilize a stop loss. And right now, those market conditions are still conducive to that upside. That's kind of the big picture. The shorter term then starts to happen where we're dealing with momentum. We're dealing with the shorter term momentum swings that happen. This slider bar, goes all the way up from extreme momentum to the upside to extreme momentum to the downside. And this sweet spot right here typically is that trending zone from here all the way up to that extreme and then back again. So we're in that location where we want to see bullish trending. Okay, and this is the S&P 500 right here, or the SPY chart. And so we're inside of that range with momentum. And that's kind of what that looks like when we're looking at a chart. Had we been back over here in the sell side, we've started to slide back down. So the trend has shifted. We've gone from here down to shifting back up. Now, the risk in any market condition or in any stock or really any trade is, well, what's going to happen? Okay, we're in this uptrend and now we're reversing. Could we continue down? We certainly could. Could we continue, or is this just going to be a bounce? More than likely, when we're at the upper end of the trend, the first spot is going to be a bounce of some kind, and that's what the market as of right now is doing. We're going to run into some resistance here. Breadth is the participation of the market. How many stocks are in uptrends or moving in that direction? About 57%. In this case, so that's not real huge participation. Sentiment also to the upper side. This is how much fear is in the market. When we're extreme, that's extreme complacency. There is no fear in the market right now in terms of S&P 500 and the put buying on the S&P 500. That's one of the indicators that is baked into that. Buy sell ratio then shortens that up, and I like this one the best. It gives us kind of the cleaner perspective of, are we extreme in the trend one direction? Okay, this is a bearish extreme. This is a bullish extreme. And are we in that upper range? Do we have green above red? Those are the most ideal situations to be trading in. When we have red above green, those are the less ideal scenarios to be trading in. Okay, market conditions, and we've experienced that this last retracement here, is even momentum stocks, and sometimes especially momentum stocks, get hit pretty hard in downtrends, in downturns. But likewise, they perform the best in uptrends. So in terms of the buy-sell ratio, you can utilize it to say, number one, I'm not going to buy anything new maybe during that downtrend, or I can say depending on your level of risk, I'm going to reduce exposure to the overall market. One of the ways to do that is with your position size. If you're adding into new positions, just buy smaller positions in downtrends and a little bit larger positions in uptrends. I got a question this week regarding that, to be, why do we change the percentage allocation? In this case, it's on a new buy daily strategy. We have it's market conditions. So the market conditions, when they're bullish, we want to try and capture that a little bit more, take a little bit more. You've probably heard the term risk on. We're taking a little more risk because the rest of the market conditions are allowing for that. They're moving higher. And S&P 500, it can move pretty nasty in short terms, but for the most part, it's kind of a big aircraft carrier, to really get turned around. And so you're going to get some pauses along the way. And in this case, ultimately, we did slide and get that downtrend. And on the 1 year time frame, we've bounced and held at that momentum zone, that 236 on the 1 year time frame. So this time frame has held up nicely on the 1 year. On the 6 month time frame, that trend is just a little bit back into that corrective zone at 382, but it's holding up. So now where we're at right now, we're in this upper momentum range, but we just started that on S&P 500. Okay, so essentially one of the things I like to visually do is just kind of draw this area and then just scribble it out. Okay, because most of the time, this is what we're trying to do. Okay, most of the time what we're trying to do is we're trying to go here and then pick up again right here. If that's this, that trend, if I were just to cut this and paste it over here and it continues, we want to try and avoid as much of the downturn. And this is more in the case of individual stocks, but in this case of a market, if we're in a downtrend, we're in a downtrend, and that can turn, it can be a retracement downtrend, counter trending, a larger uptrend, or it can be a corrective move. Either way, they're not fun, But it can also be, all right, I realize we're in a retracement. I'm not going to freak out. My positions are fine. I'm using stop losses. Or if I'm not using stop losses, I'm using position size as my risk parameter. Remember that position size is the number of shares we're buying. So when we're adding into a portfolio, we can say, I'm buying 100 shares on a $100,000 account. That's half my position. That's a huge position size. There's no way I would ever want to do that. So I've got to decide that my position goes, let's go down to 5 shares. So even 5 shares, because this is a $500 stock, is 2.5% of my portfolio. Even if that's too big and I want to go down to 2%, there's 4. So that's position sizing. And if I'm not going to use a stop loss at all, and I'm saying I'm going to buy it, I want it to, I'm going to allow for lots of volatility, maybe even potentially up to 50% volatility. I believe Buffett allows for, well, he'll allow for even more than that, but 50% volatility, he doesn't care. He's just buying it for the longer term. If you're going to do it that way, then you still have to have a risk management parameter, and that's position size. This is all you can do. If you're buying more shares, you're just taking more risk. Okay, now, if you're doing that in terms of the overall uptrend or the market as a whole, the risk is pretty small that you're going to lose everything by buying the S&P 500. Okay, the probability of that is next to nothing. And so your position size, you can maybe increase that. I'm going to buy into the S&P 500, but I'm going to buy 5%. So maybe I go up a little bit to that percent. This is your position size. And if you want to be able to take on a position size but then also define your risk, take on a bigger position size, but define your risk down less than this, then you introduce a stop loss. Okay, so your stop loss is going to say, if it drops down to let's say 490, I'm going to stop out of this trade. In this case, that's $250. So if I bought the S&P 500 right here today, and I set a stop loss clear down here at 490, and the market got all the way down to 490, and I got stopped out of that trade, and I bought 8 shares, which ended up being about a $4,000 position or a 4% position. If I were stopped out of that, I would lose $250. My portfolio at risk is my 0.24, and my trade amount at risk is 6%. Those are the two things that we can control. We can control the size of the position, and we can control if and where we have a stop loss. We can't control what the market does from here, but we just, based on prior analysis and what we expect of markets and expect of stocks, the expectation is for it to go higher. But if it doesn't go higher, we need to make sure that we are we've set ourselves up okay, so that we're not blowing out an account or we're having an unrecoverable loss. Remember that a 50% loss in a stock or in an account, okay, if my account is $10,000 and I'm really risky and I end up losing 5,000 of that, that's a 50% loss to the downside. But in order for me to go from 5,000 back to 10,000, I've got to get 100% return. So if a 50% loss is not a 50% gain to the upside, I have to get 100% return to the upside. So the upside returns are way harder to get than a quick loss. Okay, so it only goes to zero, and stocks that and that happens, and that's one of the reasons why when we're buying stocks, we're taking such a small allocation, a small position size, because individual stocks, particularly momentum growth stocks, they can get kind of jumpy, and they can, especially around earnings season, they have an earnings report and they drop. That happens all the time. Okay, but it also happens to the upside as well. You get a good earnings report and it moves solidly to the upside as well. So we're focusing on that overall pattern for those stocks. Now, during these whipsaw or counter trending times, okay, stocks are going to trend most of the time. Okay, in this case, this is a lot of green and yellow here. But once we start to get this sideways consolidation, you can kind of see where the trendless range is in the yellow, the bearish trending area is in the red, and then the green areas. What can happen when a stock is moving sideways and not trending is it's called a whipsaw. And a whipsaw is when you get signal, reverse, okay? Signal, reverse. eventually one of those is going to grab this direction and start a new trend, or it's going to grab this direction and it's going to start a new trend. Okay. And so the bulk of what we're trying to accomplish is we're just trying to accomplish these trends. But in trying to accomplish that, sometimes we've got to buy here and sell here. And that's called whipsaw. And we go through that and we get stopped out of some of those. If that happens, let's take a look on a back test and say, if we were to buy this stock, which is Broadcom, this last year, it would have been total trades. Where's that? 5 trades, 4, 3 winners, 2 losers. The 2 losers, 11% and 6%. This most recent one, this 6% is a whipsaw. Okay, that 6% happened right here on this buy. So you bought it and then you got stopped out on the sell signal, or you sold it at the sell signal in anticipation of trying to catch this trend direction. Most of the time, you're gonna get stopped out. If there is whipsaw, it might be once or twice, usually not 3 times. Okay, so a lot of times you can continue to take those trades, and so sometimes it's like, oh man, I don't this system, it doesn't work. Okay, well, trending, when we're non-trending, it doesn't work. When we're whipsawing and counter trending, we get volatility happening here. And the way that we have to manage that is position size again, right? So everything comes back to the size of the position we take, because we can't, it may be that Broadcom, if we're saying I'm betting everything on Broadcom and I think it's going to go to the moon, well, then that's not a strategy. Okay, that's not a system. That's just betting, and that's fine too. But if that's the plan, then that's the plan. That's not our plan. That's not what we want to do. We want to be able to establish a systematic process so that we say, my expectation is that Broadcom is an amazing company. It's in the electronic semiconductor space. We know that space is moving. We know AI is only going to make all of this tech stuff continue to move higher. The issue now has already been bid up. At one point, all the expectation has to turn into reality. And if that reality starts to be slower than expected, or never happens, or it's not as cool as we thought, then that's going to start to slow down some of these trends. And you're starting to see that in a lot of these names, NVIDIA, Broadcom, a lot of these also. So in this case, the position size is our risk management tool to be able to do that. And we go out another couple of years and you can see that during some of those consolidative phases, you're getting some false signals, you're getting some whipsaw, but for the most part, we're betting on the upside. Okay? We're betting on the companies growing. We're betting on the growth aspect, and even the speculative side of human nature. Humans are going to push this higher as long as it happens. Well, we want to participate in all that. We don't necessarily have to have an opinion on, I think the price to earnings ratio is overbought, or it's overvalued, or it's doing this, or it's leaving, it's got more competitors and this or that. Let someone else figure that out and then make their decisions and push it higher. We're focused on the trending stocks and the trending moves of the stocks. This will get us out of danger. Sometimes it gets us out of good trades long term, okay, but we can always jump back in. Okay? We can always jump back in. If we get stopped out, or if it's something we just, even here, if it's like, I believe in this, or even if I don't believe in it, it's a buy signal, it's an uptrend, and it's a 95 ranked stock. Granted, maybe this is the wrong example to use. It's a $1,300 stock, but this is, whether it's $1,300 or $1.30, it's the same process, it's the same pattern, it's the same expectations as well. Okay, so let me jump back to talking about position size and market conditions. That's what ultimately what this was all about, and that is that we have a buy-sell ratio which is greater than 1. So buy-sell ratio down here is sitting right at 1.93. So we have almost a 2-to-1 upside to downside stocks, 2,000 upsides. You can see buys to 1,000 sells, and then a whole bunch of holds in the middle. That is also showing here on the chart, S&P 500. We're in an uptrend, okay? And now, whether or not this you know, I've mentioned this before, whether or not this turns into more downside, that could certainly happen, but we'll know it when it happens. We're not going to know it yet, but that's always the battle. That's always the battle, is we don't know the future, but we know what the rest of the entire planet thinks of the S&P 500. Okay, this is all market participants making decisions right now, and this is what they believe that is happening, or what they believe should be happening going forward, is price trends are moving higher. At some point, that is going to shift. Okay, at some point, that's going to look like this again. It's going to look like this again. But what usually happens first is that yellow phase. Okay, you've got a yellow phase. You've got a yellow phase right here. You've got a yellow phase that we're kind of working through right here. Just that sideways consolidative yellow phase. But most of the green and the red, those are the trending zones. Those are when we're in an uptrend and a downtrend. It's the yellow consolidative phases that ideally we don't want to participate in, but we get stuck in them sometimes as it's transitioning from a buy to a hold to a sell. But it allows us to make some decisions. We know that trends are weakening. We know that maybe we want to lighten up on some of our position, or we want to whatever the decision is that we're going to allow, it comes from market condition. Are we in an uptrend, or are we in a downtrend? And what does that mean for my risk that I'm willing to take, my allocation that I'm going to be exposed to stocks, and how many stocks, or stocks at all? Am I buying ETFs instead, and diversifying, utilizing ETFs instead of the individual stocks, using the muscle stocks groups? You know, you've got stocks that are in some of these uptrends here as well. Industrial, a lot of these are just the triples. But let's see if there's any aerospace defense. So some sector ETFs that are happening in there. So again, even on the sectors, if I'm buying all of these, everything you see here is an ETF that's tradable. You could buy or sell anything here. You don't have to have futures for the commodities, but the sectors as well. If I wanted to buy directly into the utility sector, which has been moving nicely, then I could do the same thing, focusing on IDU as a percentage of my overall portfolio. Maybe I want to own the entire utility sector, and that's a way. This is a way to be able to do it. But I would still enter into this sector the same way I would a stock, at certain locations, and we had that happen right here. So utilities actually led us out. It was rallying during most of this retracement, and it's kind of led the market out of this most recent counter trend right here. So that could be a way to diversify, to say, instead of buying a stock, I'm actually going to one stock, I'm going to buy all of the utility sector by owning IDU. It's in an uptrend. Or I want to own crude oil, so I'm going to buy, in this case, I would be looking at commodities. I'd be looking at USO. Oh, it's in a downtrend. Okay, let me wait. I'm going to wait for that one to go back into an uptrend. There's no reason for me to buy it now. Now, depending on your perspective of analysis, you would argue, well, this is a retracement. This is a three-part counter trend. It's right at a 382 support area. Isn't that a typical area for a momentum move higher? Yes, it is, but it could also turn into this. I don't know if it's going to turn back into an uptrend, or if it's going to roll back to the downside. I'm not willing to buy it here in hopes of this, until it gives me some proof that it's going to do it. It goes from red back to yellow, and then back up here, and then it starts, and then we get a new green bar back up here. Then we could say, oh, okay, oil has reversed its trend, and appears to be in a new uptrend, and we're going to start participating in that new uptrend right here instead of right here. Although buying right here is a reversal strategy for a lot of traders, buying directly at support and resistance zones. In this case, the momentum strategy is not doing that, but again, you can flip-flop strategies all you want, as long as you're buying and selling based on that specific strategy, and using stops and using money management. That's why there are so many strategies, because some people just gravitate to a different method. So they like it, it feels more comfortable, and they understand it a little bit better. But in this case, lots of times what we think and feel is wrong. And so if we get too comfortable with something that's not working, then obviously that's not going going to work. We want to be, if it means getting into something that is working and you got to change your comfort zone just a little bit to learn a new method, then that takes a little bit of time to be able to feel comfortable with that. Let's just recap here. So current market conditions, again, we're in that bullish up zone. Stocks to be looking at are your muscle stocks group. You got your new buy list. Hey, these are the stocks, anything that's above 90. Ideally, those are the ones to be focused on. That just happened to pull up AVGO because that was in that group here, which is Broadcom. And there's always a list of stocks to be in there, whether or not there's a lot or whether or not, a lot of times even you can go down here and you're getting some additional stocks in that lower list. That being said, the first place to start is that top of the list. You can also look and see maybe that top 3 or 4 or that top 10. Okay, I'm gonna consider some of these, and maybe Broadcom. It's like, it's $1,300. That's outside of my capital account. I couldn't buy it, so I'm gonna get rid of that one. And maybe I'd say, I'm liking pharmaceuticals right here, so maybe I actually jump in and consider a pharmaceutical, or whatever that additional strategy is to be able to make the entry. A lot of times it's just simply, I've got a new buy signal, so I'm going to go into that trade on the next trading day. Okay, and that sometimes these will happen. You get an entry, so I would typically place stop losses down a little bit deeper to allow for some volatility. And it doesn't, if our stops are too tight, oftentimes we're not doing we're not allowing the stock to do what it needs to do, and that is market participants are going to create volatility. But overall, if the company is moving in the right direction as far as profitability and growth and everything else that a company has to do, this is going to continue to move this direction. If not, what do we care? Who cares about this? Okay, it doesn't matter to us unless it's moving higher. Okay, it's going to give us different ups and downs and different looks and different opportunities. But in terms of saying, I really think that a metal is going higher, I really think that this is going higher, it doesn't matter. It doesn't matter what I think. It's what is happening. And if it doesn't happen, we can't say, I'm, this or that, or excuses or reasons, or it's just, we just got stopped out, and the stock didn't move higher because the market participants did not agree that it should go higher, and they sold it. That there are a million reasons why it could be moving up or down. We just want to make sure we are in something that has a shot of going higher and we're managing our risk. I'm going to end on that note. I appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.